I'm Owen Bigland. This is the Inside Edge video blog. It's that time of year again, the fall. It's a time when I start to get invited to a lot of real estate seminars, outlook conferences, intelligence meetings, and this fall is no exception. I've been attending a few in the last month, and I'm expecting to attend at least another one or two more in the next few weeks. But one that I went to last week that I was fortunate enough to get an invite to is the annual Rennie Intelligence Conference. And I'm fortunate enough to have gotten an invitation to this for the last 2 or 3 years. And when I do get the invite, I usually always clear my calendar and make sure I can come down to it. This year it was a breakfast meeting at the Pan Pacific. They put out a nice breakfast, and they bring out their in-house economists and analysts to talk about the current state of the real estate market in Vancouver and what their outlook is for the next couple of years. And I always make a note, when I've talked about it before, when a guy like Bob Reni speaks, I listen. And if you remember, I've mentioned this in passing a few times in my blog here, and I still remember it was like it was yesterday. I tell the story about 12 or 13 years ago. I was invited to a Vancouver Board of Trade luncheon where Bob Reni was the keynote speaker. And at the time, Vancouver Real Estate had been on a pretty good roll, although by today's standard it seemed cheap. Back then you could buy a one-bedroom, one-bath West End or Yaletown condo or Cole Harbour condo for around $300,000. And everyone at that point was saying, well, this is nuts. Prices are up dramatically in the last 3 or 4 years. They would always point to the fundamentals, which was wages. You know, the average guy in downtown Vancouver is making $32,000 a year, and he needs to be making $75,000 to afford a typical one-bedroom condo. Back then, you could buy a 2,800 square foot detached house in Richmond for around $410,000. Now, Bob Reni was one of the first people, I think he was the first guy that I had ever heard about an equity-driven market. And nobody knew the market better than him. He had dozens of display centers open that were continuously feeding him data that he had exclusive information on, basically. So who was buying his units? Who was buying his pre-sales? Where were they getting the down payments from? Was it an equity-driven buyer? Was it help from mom and dad? Were they buying 1 bedrooms, 2 bedrooms, 3 bedrooms? Were they buying them to live in? Were they buying them to invest in? But he was one of the first guys at that time that was saying that it's an equity-driven market. It's people that have been in the market for years, have ridden it up, have got a tremendous amount of capital gain, and now are buying an investment unit or 2 investment units, or maybe downsizing or upsizing and using some of that equity. Or it was also help from the bank of mom and dad. And it struck home for me because I was kind of in that same boat myself. I had been in the market for quite a while. I was continuing to buy new investment properties by taking out equity from some of the properties I had bought decades ago. Same thing with some of my colleagues and many of my friends and associates. So it struck a chord with me. But of course, he took a lot of flack at that time, saying he's just a marketer. Of course, he thinks the market's going to continue to go up. This equity-driven market doesn't mean anything. Eventually, fundamentals will override all this, and that $300,000 Yaletown condo will go back down to $150,000, which is what the average guy can afford. So he was spot on. It never happened. So again, when he speaks, I tend to listen because, again, they said at this conference he currently has 22 display centers open. 22 centers that are feeding him data every single day on who's buying what, how are they getting their down payments, how much money are they putting down, where's the funds coming, is it equity driven, are they an upsizer, downsizer, whatever. And then he feeds that to his in-house economists and analysts. They produce this nice little booklet that they give out every year. And there's some incredible information in here that I'm going to share with you guys. But to make a long story short here and summarize everything in the hour and a half that they spoke, the long-term outlook for Vancouver real estate is exactly what I've been telling you here for the last 9 years. It's incredibly bullish. You buy a condo today downtown Vancouver, live in it, enjoy it as your principal residence, you need shelter, it certainly beats renting. Have a look at what it's worth in 20 years and you're going to be more than pleased with the results. Or if you're thinking about diversifying your retirement and your investment portfolio, you've got your TFSAs and your RRSPs maxed out, now you want to diversify into real estate, buy a good quality one-bedroom condo in downtown Vancouver or Mount Pleasant or Main Street Corridor or Kitsilano. Buy it, put a tenant in it, let the tenant pay everything down in 20 or 25 years, and again, have a look at what it's worth, and I think you'll be more than pleased. Here are a few takeaways. Why Rennie and his analysts are pretty bullish overall on the long-term outlook for Vancouver real estate, as am I. They talked a lot about population growth, how Canada right now has a mandate for more immigration. Something like 350,000 new immigrants will come into Canada annually between now and 2021. So about 300 to 350,000 per year. Last year, about 45,000 came to BC. Of those 45,000, about 41,000 settled in the Lower Mainland. For obvious reasons, because this is where the jobs are. This is where the transportation is, the housing, and everything else. Talked about wage growth. Wage growth is currently running at about 6% in the province of BC. That's about double what the rate of inflation is, and it's much higher than the Canadian average. So wages are growing here. Overall, the Canadian or Vancouver, BC economy is quite strong. However, there's always some caveats there and some danger warning signs. The BC economy, the NDP government inherited the strongest economy in Canada 2.5 years ago. It is starting to show signs of fatigue and slowing a little bit, although it's still fairly strong. We talked about, of course, what I've blogged about many times before, the lack of available land, how expensive land is, especially in downtown Vancouver and the surrounding neighborhoods like Mount Pleasant or Kitsilano. Very difficult to get anything built. We do a trickle-in supply here, as I've blogged about many times. You gotta go through the city, getting the zoning, getting all the permits, then you gotta cross that gauntlet known as the NIMBYs to get anything approved. Anything that is going to be getting built in Vancouver moving forward, especially in the downtown core, is going to be luxury condos only. Nothing that anyone even remotely would consider affordable. So we're talking $1,800 a square foot and up. There's stuff in Cole Harbour now that's going to be selling at over $3,000 a square foot. So I'm under the belief, as is Reni, that if you can still buy a good quality downtown condo for around $1,100 a square foot, $1,150 a square foot, buy it, keep it, enjoy it, or put a tenant in it for the next 20 years, I think you're going to do pretty well on it. So those are just kind of some of the takeaways, but the overall sentiment, of course, is, again, the long-term outlook for Vancouver real estate is pretty solid. There's always going to be some dark clouds along the way, and they talked a little bit about that. Government uncertainty with the taxes. You know, the NDP government does not instill a lot of confidence in business, that's for sure. They never met a tax that they didn't like, and they are showing signs of slowing the economy a little bit here. We'll have to see where that goes, or if there's more taxes, something that they're trying to do to cool this market further. Hasn't done very much at all to the condo market, as I pointed out to people here. It's basically unscathed. What it has done, of course, though, is affected the high-end luxury $2, $3, $4 million properties. But for the average Joe who's looking to get into his first home, prices are not off all that much. Talked also about that coiled spring effect that I've mentioned before, where, you know, new development, there is some, but it has slowed. There's a lot of uncertainty with developers. When you put that into overlap that with the population growth and 45 or 50,000 new people coming in every year into the Lower Mainland, you know, we've always had a shortage of supply. It's always a trickle-in kind of supply theme we use here, yet demand continues to be ultra high. Throw in interest rates as well. Interest rates now have been continuing to come down. You can lock in a 5-year rate now at about 2.75%. Those might even come down a little bit more. Of course, interest rates kind of drive the housing market. With these type of rates, you know, that definitely stimulates a borrower's purchasing power. So all in all, to tie it all with a bow here, is the long-term outlook for Vancouver real estate continues to be incredibly strong. If you're a renter right now, I would, you know, strongly urge you that you should be possessed to try, and you want to stay in Vancouver. Nothing wrong with renting short term, as I've often said. But if you like the city, you've got a good career here, you want to stay, you have to get off that renter treadmill. You need to come hook or crook, save everything you can over the next 3 or 4 years to get into the market. It'll be the best decision you've ever made. The tough part, of course, though, is getting that $50,000, $60,000, $70,000, $100,000 down payment. Once you're in, at sub 3% interest rates, your holding costs to own aren't going to be much more than what it's costing you to rent. If you're buying a principal residence, you're going to have a 40 or 50 year need. Don't worry about trying to time a market or what the market's going to do this year or next year. Buy it, enjoy the home, live in it. If you outgrow it, let the equity build up and move up market. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.